Today we are myself, Jonas, and my colleague David Harris presenting. And indeed, it's quite a special occasion since the fund has turned 10 years actually now in May. The fund started in May 2015. And of course, we're going to have a few look backs at what has happened during those years. And we'll also take a look at portfolio positioning, of course, new ideas that we have, new investment cases that we have in the fund. As well as taking a look at the drivers that might lift not only value stocks globally, but also, of course, our own portfolio in the next 2 to 3 years. And then we will run for approximately 30 minutes, and then we will take Q&A if there's any questions. And the picture you're looking at here, of course, it's a sign for the great rotation, as we call it. And what is the great rotation? Well, that is the tendency for capital to finally move from the US equity markets and US assets in general into other more discounted and ignored areas in global financial market outside the US. And this is something that we are going to explore in this presentation in more depth. But first, we'll just remind you what SKAGEN Focus is all about. And we're focusing on global small and mid-cap stocks. We're thinking about mid-cap names up to about $10 billion in market cap. We can also hold exceptional larger cap cases. Right now, we have about 90% in small and mid-cap companies. We don't invest in anything that we don't think is deeply discounted. And with a deep discount, as value managers, we demand at least a 50% upside in 2 to 3 years' time to our price targets, which is based on a normalized or steady state earnings power. So we don't take growth estimates 5 or 10 or 15 years far in the future into account. We try to model the company as it looks today, basically. And also that also incorporates the balance sheet. We're very balance sheet driven in our company analysis. And we like to focus on unexplored or undiscovered assets within the balance sheet, such as real estate, cross-holdings in Japan or Korea, or net cash positions and so on. And this makes for a very unique exposure you get when you acquire units in SKAGEN Focus. And these contrarian phenomena that we look for, David, which are those?
Thank you, Jonas. Yeah, we call ourselves contrarian investors. And what do we exactly mean by that? Of course, to a large extent, we believe that we operate in a quite efficient market, but there are pockets that constantly appear within the market where we think there's a higher likelihood for market inefficiencies. And to find those, we try to identify contrarian phenomena that can occur in different sectors and geographies and where the likelihood is higher. And just to give you a few examples, it can be as easy as some companies might be listed in one part of the world, but have their operating assets in a completely different part of the world. And just by that, they can tend to be easier misunderstood. We find a lot of inefficiencies among small cap names. They have less coverage than the large caps. Sometimes they don't even have coverage at all. We have a couple of instances in Japan, for example, where that is the case. We try to find pockets that are below the radar for most investors, that are forgotten or ignored, and we try to identify temporary market dislocations when we look for value and get back to examples of those type of situations. But the key is to identify value. And if we take a look at our investment process, we have 3 building blocks, you could say. If we start from the first one beneath, it's cheapness. It's all about price. This is a price-driven investment philosophy. Nothing comes into the fund if it doesn't offer a substantial discount at an attractive price. But of course, many things can stay cheap for a long time, so we need to be able to identify catalysts that can support the re-rating to drive change in the position that we hold. And we do this, lastly, with a high degree of common sense. Common sense when it comes to our focus on balance sheets, on our focus on companies that can deliver cash flow here and now, and diversification when it comes to risk management. We have been operating together for quite some time now, over 10 years, me and Jonas, and has gotten some recognition for that over the years. And we operate within SKAGEN, which has, as many of you know, more than 30 years of experience when it comes to value investing.
Yes, and we like to show you this chart, which essentially shows you the development for so-called value stocks, that is cheaper stocks with low price book, low price earnings, versus growth stocks, which have higher price earnings and higher price book. And this is the development since 1975. We like to incorporate this slide into our own 10-year anniversary, if you will, by looking at these periods, which are highlighted in the chart, where the first period, of course, where value assets had a great degree of difficulty versus growth assets, was heading into the IT bubble in, let's say, 99 and 2000. Following that period, there was a very nice and interesting development for value shares, as you can see, versus growth stocks. In the number 2 period, which was characterized by extremely low interest rates with QE, if you remember, in some cases even negative interest rates. You had also the development or the emergence of the tech monopolies in the US during the same period. This is a 10-year plus period. And SKAGEN Focus was actually launched right in the middle of this development in May 2015. So needless to say, the first year was pretty rough in terms of relative performance. 2016 was a very good year for us, both in the relative and absolute terms. But from an overall perspective, there's been a headwind, we must admit, to the style that we manage money with, i.e. value-based contrarian investments. We had a brief period in the pandemic or following the pandemic where interest rates were normalizing and inflation came into the picture. That was a very good period for the fund, and also the following years actually. We even got an award for being the best global small mid-cap fund over 3 years and also over 5 years in many different geographies. Of course, 2024 was a difficult year with a great focus on big tech stocks and artificial intelligence and so on. Heading into 25, things seems a little bit better on a relative basis, as we have these tendencies such as the great rotation, which we mentioned, that's coming into play. And the factors that can normalize this value versus growth and also would be highly beneficial for the fund is three different market forces, if you will. We can also say from an absolute perspective, the fund has done pretty well during that 10-year period. It has increased more than in excess of over 100%, of course, in Norwegian kronas. And these 3 potential drivers that can drive value versus growth and our fund as well forward, both from an absolute and a relative perspective, are, for instance, the great rotation, which we have mentioned. We have been underweight US stocks for quite some time, which has not been it's been a choice that we made too early, as it looks. The catalysts have now maybe come into play, which is quite interesting. So we'll take a look at the great rotation and the potential for that to continue. The other aspect we like to highlight is what we have called the magnificent gap, which essentially is the gap in valuation between small and mid-cap stocks globally and large mega-cap stocks. It sits at historically record levels still. And the third thing we like to mention is the tariff picture, which has essentially put a tariff shadow, basically producing an undervaluation, a severe undervaluation of global small and mid-caps globally, primarily, which also has the potential to be clarified as we go into the next few years, which would be highly beneficial for a large part of our portfolio. So these are the 3 forces or the 3 drivers from more an overview perspective. And take a looking at the great rotation. So we have seen these tendencies really form this year, where assets or capital are flowing out from the US into other more ignored and discounted markets. That goes for the US equity base, that goes for US bonds, that also goes for the US dollar. And essentially, what investors are saying, that they're starting to demand a higher risk premium for owning US assets. And that is quite visible in all these different asset classes in the US. At the same time, inflation expectations have risen rapidly in the US due to the tariff picture. You have a potential supply shock, i.e., products are getting more scarce on the shelf, which is now potentially happening in the US. There's a standstill in investment following the Trump Liberation Day, which has created huge uncertainty. All of this had also produced a focus on the concentration risks in global passive mandates, equity mandates out there, where of course 70% of these are sitting in US equities and the US dollar. So this is something that has happened, and what could take shape going forward? We believe there might be a decent probability for further negative earnings surprises in the US, especially if you're domestically based. You're going to see most probably lower interest rates outside the US because of the inflation dynamics, that these tariffs are almost taking down the inflation dynamics outside the US due to the Chinese goods that might flow these markets instead of coming to the US, for instance. So the relative rate picture looks to be highly beneficial for rest of the world versus the US. And we think this will eventually produce a number of string of trade deals in the US, which would also benefit the stocks outside US rather than inside the US equity market. And this is something that we think will be enough to sustain this rotation out of US assets into the rest of the world. And of course, that would be very highly beneficial for value and for our fund specifically. And when it comes to the Magnificent Gap, which we call it, instead of focusing on the Magnificent Seven, this ratio between small and mid-cap stocks and large mid-cap stocks has essentially steadied. It's stabilized. Nothing has happened over the last few months or last year or so. Still sits at historical levels, the deep discount in global small mid-caps, especially within the cyclical complex of the global small and mid-caps. And tariffs have also been more severely priced into small mid-caps rather than large mid-caps as it looks right now. So as money starts to flow out of the US and will find other markets, we believe there's a highly likelihood that this will be driven by fiscal and monetary policies outside the US. For instance, in Germany, we launched a massive fiscal stimulus package. We think those dynamics will benefit moderate small mid-caps rather than the large mid-cap stocks. You'll also see a higher activity in M&A, which already is visible. And maybe funds are starting to turn from the passive mandates into active mandates in general. That would also be a cause for re-rating, a flow dynamic, which would be highly positive for global small and mid-caps. So these are two strong forces that could normalize. This is just to show you the exact numbers of the discount that's sitting in price to earnings and price to book in global small mid-cap versus large caps. And you see this discount is 15% and 45% when it comes to price book. Normally, these small and mid-cap stocks are more expensive than the large cap. So this is a dislocation in global equity markets currently that could normalize.
Yeah, and then we have the third driver or opportunity, so to speak, and that's the tariff shadow, the temporary market dislocation that has been created by this broad reaction within the market from the new US administrations and the recent actions. If there's something that the market really can't take, then it's the lack of visibility, and that's exactly what we're experiencing now. If you just look at certain sectors that has been substantially hit by this, these are of course sectors that are exporting into the US. We see a lot of automotive and auto parts suppliers that have been severely hit, especially regions such as Mexico or Canada that are shipping goods into the US. There's a high degree of uncertainty, and people are wondering how this will play out when it comes to price increases, effects of inflations, and so, which creates a very attractive opportunity, we believe, as some of these companies are now pricing in worst case scenarios, and we have started to see trade deals with different countries, and we're expecting more of those to come. And as the market gets more clarity and visibility, we believe it will be easier for the market to distinguish between these different companies and of course their positioning. So we can find a lot of attractive opportunities in these areas of the market now created by what we call the tariff shadow. Another observation that we wanted to share with you, which we think is very interesting, is when you take a look at valuation on a regional basis. And what you see in front of you now is price to earnings ratio over the last 20 years for different regions. You see the black dot, which indicates where the ratio is trading at right now. The blue one is the median, and then you see in black the range in which this region has been trading over the last 20 years. This is, of course, a somewhat simplistic picture, but it still gives you some observations. You can see that US as a region is trading not only in absolute terms at a very high level compared to the other market, it's also trading outside where it has been trading most of this time during the last 20 years. Even so, when you adjust for the very high US tech valuations. And we note more to the right side of the chart, the valuation levels which are offered to us in emerging markets, or even countries like we mentioned recently, Mexico, where you see an extreme undervaluation compared to other regions, and especially versus its own historical trading. So interesting to note, and we'll get back to what we can find in those regions.
Yes, and we're not only interested in finding these deeply discounted assets. As contrarians, we also like to think about the expectational cycle around the stock. And every stock follows this sort of clock, this investment clock, as we like to call it. We just want to highlight that we are often most involved in the lower parts of this clock, of course, when the stock gets neglected or perhaps even completely ignored and forgotten by investors. They're usually associated with very low expectational picture on profits and so on going forward. And you have a situation where perhaps not even bad news is sort of producing a negative stock reaction. And we look for that in terms of how we time and how we sort of scale into our investments. As contrarians, we scale in because we know it's very easy to be too early into an investment case. And when the tide turns, eventually with a strong balance sheet, there's time in the game. So when the general investor wakes up and there's been a few positive earnings surprises and so on, we often get our 50% plus in the equity re-rating and leave the case and invest in a new fresh discounted stock. So that's a little bit how we think about the timing of purchases within SKAGEN Focus. And I also want to highlight how we think about the different value segments in the fund. We don't only have one type of value in the fund, we have several type of value types, which essentially the most common one is mean reversion value, where something normalizes back to the mean, either on the income statement, the cost side, or the income side of a profit loss statement. Could be the balance sheet, could be leverage, could be interest rates, and so on. Economic return value is something where it earns a very high return on its capital, but the market refuses or don't price it correctly, we think. Something is clouding the market. They can't see it, they won't price it in. So that's another type of value, which is quite interesting. And also restructuring breakup value, sum of the parts value. Asset-backed value, where you have a lot of hidden assets in the balance sheets. This can also be combined with the other value types. And also discount on discount value, which essentially is layers of value when you have a holding company like XOR, which we will take a look at later in the presentation, for instance. There's layers of discount in these holding companies status. So we have a mix of this, and this is only a selection of a portfolio, which you can see here on this chart.
Then a little bit more on the process and the constant movement and flow that you see going on within the fund and the portfolio. This is, of course, a very active strategy, ultimately driven by price. We are contrarian, we are often too early, which is why we slowly scale into positions. And then we can, as we build the conviction with regards to change the catalyst, we can then increase the position size. And this process is ultimately driven by risk reward. So if a position is starting to trade closer towards its price target, we would then reduce the position and scale into other ideas and positions within the fund that offer a higher or better risk reward in order to keep the fund at an attractive level for our clients. There are essentially three reasons for a company to leave the fund. Either we hit the price target and are correct in our thesis, or we discover a thesis violation, which leads to that we scale down in the position or exit the name, or there's a duration limit. We know that as value investors, it's easy to get caught up into value traps. So we have a 3-year duration limit. If we don't see catalyst playing out within that time period, we sell out by default. So this is the constant movement that is going on. We have 50 positions, up to 50 positions in the fund, and always try to keep this freshness and attractive risk reward within the portfolio. We have been compared by a third party to other global active managers. And as you can see, there's no doubt when it comes to our focus on price and price-driven process. When we are compared to other global active managers, we really stand out when it comes to the portfolio and how it's being priced. You can see us in the bottom percentile when it comes to price earnings and price to book. We seem to be the absolutely cheapest fund out there. But then still our focus on solid balance sheet, on cash generation stands out, as you can see when you compare us to other managers on the dividend yield in the fund, which is quite high. Another interesting observation when it comes to SKAGEN Focus and how it could be used as a building block together with other products and global strategies. You see our positioning when it comes to the regional positioning. We have quite high exposure to countries like South Korea, to Japan, where we find a lot of value. And as value investors, we struggle to find attractive ideas in the United States. We have positions there, but it's much more difficult for us with our price-driven strategy to find something, as opposed to how many other value or global active managers are positioned, where you see a substantial part of their allocation being towards the US.
Yes, and this is also we just showed you the positioning versus our active pairs. This is the positioning versus on the geographical basis versus the index baskets that are out there. And as you can see, the US is approximately 65% of the MSCI ACWI, that's the global index, and the small and mid cap index, it's approximately 55%. We're only at 10% US equities currently, due to the reasons that we have talked about here, primarily from a valuation perspective, but now also the catalyst seems to be shaping up for this position. We admittedly have been too early, but instead we have a large exposure to European equities, and we think European equities are highly interesting now with the fiscal and monetary stimulus that's going to happen over the next few years. Defense industry is building up. The whole industrial complex from a cyclical perspective is trading extremely cheaply. This is 40% of the fund in those type of positions. Then we have a lot of Japan, Korea, and Mexico, and so on in the rest of the fund. But this is just how to show you how we deviate from these index baskets currently.
Yeah, and then a few words on price discipline. We value stocks on a normalized earnings basis. You can expect us to have a strict discipline when it comes to our price target. We have closed 4 positions on price targets year to date. We closed 14 at target last year. Here you just see a few examples. You have the white cement producer Cementir, which is listed in Italy, mostly operates in Scandinavia. We have Japan Post Holdings, which was a phenomenal run for the fund and had its last run here this year. And also the US specialty insurance turnaround Old Republic, which we closed at target this year, just to give you an examples. But maybe we can take a look at some of the new ideas that has been taking place in the fund this year. And then maybe we can start with an example from Mexico, which is a very attractive region, as we spoke about before. And this is an example of the type of opportunities we could find when it comes to the big tariff shadow. We have invested and started to increase our position towards a 2% position now in Traxion, which is a small cap Mexican logistics company. This company operates across different logistics segments, everything from freight to warehousing to delivery of personnel and this type of transportation. This is a company that has a very strong position in Mexico, very diversified client base. It works with all the major companies present in the region. They have started to consolidate this region over the last years. And of course, they are dependent on the nearshoring theme and of goods flowing into the US, but this stock has been completely hammered in this environment. It's now trading at almost 3 times its cash flow, despite this very attractive positioning, which we think has created this opportunity. And we do believe that these companies has a valid positioning within Mexico, and that the US is ultimately dependent on the region to a large extent. So very attractive opportunity, we believe.
Yeah, and we have a strong history of investing into Korea and also into Korean financials. We have historically held KB Financial, which left the fund last year, was a highly successful position in the fund. We currently own IM Financial as well, formerly DGB Financial. It's been very strong this year. And B&K Financial is now replacing our position in KB. That's the way you think of it. And it reminds us very much about those investment cases that have been successful for us in the financial space in Korea, with an extremely low valuation, in this case, 30% of book value. You got a CET1 ratio of 12.5%. And you got a very clear path to value creation when it comes to where they want to take the return on equity, and also how they're going to buy back shares and cancel those shares in these value up programs that the Koreans now are launching. So that's very interesting. The mean reversion aspect is more or less from the property write-down they did in their property book just recently, which we think is a one-off. And this will, when the market starts to focus on the core earnings power, we believe B&K Financial have at least a 100% upside from here in Korea. It's 2% of the fund. In Exor, it's a new position within the discount on discount value segment. Exor is trading in Holland and owns assets like Iveco, Stellantis, CNH Industrial, Ferrari, and so on. And they've been very successful in allocating between these assets. They're now selling Ferrari and buying the highly discounted parts of their portfolio, which is Stellantis, the car maker, and Iveco and CNH, for instance. And the holding company is trading at a 50%. It trades at 50% of the value of its listed assets. So it's a huge discount, which we believe is completely unwarranted. They're buying back shares and so on. It's a 2% position in the fund as well currently. And looking at the contributors so far this year, the portfolio is down about 2%, I believe, in euro terms currently, a few days ago. The best position being Cementir, which David mentioned, which has left the fund at price target. Ayvens is a car leasing company based in France, which at the time we're trading, it's up 35-40% this year. It's at the time we're trading at about 35 times book value. It's a merger between two different companies, which has been extremely ignored, we think, by markets. Now re-rated K+S, a potash maker, fertilizers, is up sharply this year, over 50%, which we're now scaling back. It's been a very strong performer for us. And on the losing side this year, so Metanex has been weak. It's an outage in one of the plants, basically, which was taken very hard by the markets, too hard in our opinion. And apart from that, the detractors have been pretty limited so far this year. So and looking back at the history, we won't have the 10-year history, but we look back 4 years here. So 2022 was a pretty good year for us in terms of relative terms in any ways. 23 was a very strong year. Despite not holding any of these tech stocks in the US, we managed to beat both the Acque and the SMID, which was a pretty strong performance. And of course, we mentioned 24, not a good year for the fund on a relative basis due to the artificial intelligence theme that were sort of dominating the markets. And again, this year, things looks more promising. And especially we get this great rotation and that sort of thing really firming up this year. That would be very interesting for us to follow the impact on the fund.
Towards the end, maybe just to start wrapping it up with some portfolio composition highlights. We have currently 46 positions in the fund. Majority of those are small or mid-cap stocks, and we have a substantial upside we see currently towards our weighted price target within the fund, which is quite elevated. Depending on all these opportunities that we see, these companies being severely discounted, we have a quite fresh portfolio. 39% of the portfolio is initiated less than 1 year ago. We closed a lot of positions last year, rotating into fresh ideas with massive upside to keep the portfolio fresh. We have a fund which offers a strict price focus, as opposed to what you see and maybe the benchmark or small mid caps in general when it comes to price earnings or price to book.
Yeah, so taking a look at the top 10 positions, which currently are 33% of the fund. We have, as you can see, a few names that we haven't mentioned. We have Acerinox, for instance, which is a Spanish-based stainless steel producer, which ironically have a very large operation in the US. This is basically a US company trading in Spain at a huge discount to what these stocks trade within the US. So that's a very interesting misunderstanding, we think, for Acerinox, over 100% upside. We also have some US stocks, as we have mentioned. There are not many, but we have Albertsons, a food retailer. That's a failed merger with Kroger, which has now been completely ignored, trading very cheaply. And also CNH Industrial, which is an agricultural machinery company and a construction machinery company, trading at a vast discount to what we believe is fair value. So that's the top 10. And just to sum up for you, we think we have a unique process which is anchored to the three dynamics that we discussed: cheapness, change, and common sense. And we now have three interesting market forces or drivers that could really benefit the fund going forward from an overview perspective. And that's the great rotation, i.e. capital flowing out from the US into discounted and ignored areas in the rest of the world. The magnificent gap closing, at least partially, that is the spread between global small and mid cap and large cap, mega cap stocks in terms of valuation, sits at historical high. And the tariff shadow. The market starts to differentiate between real world impact and the perceived impact. And the upside of the fund is almost 90%. So it's a substantial upside to our price target across the fund at the end of this period.